Mutual funds and exchange-traded funds, ETFs, are two popular investment vehicles used by individual investors, but they differ in key ways that can influence their performance, costs, and suitability for specific investment strategies. Both offer diversification, allowing investors to access a range of assets through a single investment. However, understanding the distinctions between mutual funds and ETFs is crucial for making informed investment decisions. In this video, we will explore the top 10 differences between mutual funds and ETFs. 1. Trading mechanism. The primary difference between mutual funds and ETFs is how they are traded. Mutual funds are typically bought and sold at the end of the trading day at the fund's net asset value, NAV, which is calculated after the market closes. This means that all transactions, regardless of when they are placed, are executed at the same price after the market closes. In contrast, ETFs are traded like stocks throughout the day on stock exchanges. This allows investors to buy and sell ETFs at any time during market hours at market prices, which can fluctuate throughout the day. 2. Management style. Mutual funds can be actively or passively managed. Actively managed mutual funds employ a fund manager or a team of managers to make investment decisions with the goal of outperforming the market. Passively managed mutual funds, often known as index funds, track a specific market index like the S&P 500. In contrast, ETFs are typically passively managed and track a specific index or sector, although actively managed ETFs also exist. Generally, ETFs are more likely to be passively managed, which typically results in lower management fees. 3. Expense ratios. Mutual funds, particularly actively managed ones, generally have higher expense ratios because of the costs associated with research, trading, and management fees. These expenses are deducted from the fund's assets before distributing returns to investors. ETFs, due to their passive management style and lower trading costs, typically have lower expense ratios than mutual funds. While actively managed ETFs exist, they still tend to have lower fees than most actively managed mutual funds. 4. Investment minimums. Mutual funds often require a minimum investment, which can range from a few hundred to a few $1,000s, depending on the fund. This minimum can be a barrier for some investors who may not have the capital to meet these requirements. ETFs, on the other hand, have no minimum investment other than the price of a single share, making them more accessible to a wider range of investors. Investors can buy as little as one share of an ETF, which may cost much less than the minimum requirement for a mutual fund. 5. Dividend distribution. When it comes to dividend distribution, mutual funds and ETFs handle payouts differently. Mutual funds typically distribute dividends to investors on a regular basis, such as quarterly or annually, depending on the fund's income-generating assets. Investors can choose to have dividends reinvested into the fund or paid out in cash. ETFs also pay dividends based on the underlying assets in the fund, but dividends are usually paid quarterly and can be automatically reinvested through a dividend reinvestment plan, DRIP, offered by most brokers. 6. Liquidity. One of the most significant advantages of ETFs over mutual funds is their liquidity. Since ETFs are traded on stock exchanges like individual stocks, they can be bought or sold throughout the trading day at market prices, offering greater flexibility. On the other hand, mutual funds are less liquid because they can only be bought or sold at the closing NAV, which means investors must wait until the market closes to execute their trades. 7. Tax efficiency. In terms of tax efficiency, ETFs are generally more favorable than mutual funds. This is because ETFs use an in-kind creation and redemption process, which helps limit taxable capital gains distributions. When investors buy and sell shares of an ETF, they are typically not subject to capital gains taxes unless they sell their shares for a profit. On the other hand, mutual funds may distribute capital gains to investors even if they have not sold any shares, particularly if the fund manager has made trades that generate taxable gains. 8. Transparency. ETFs offer a high level of transparency because they typically disclose their holdings daily. This allows investors to see exactly what assets are in the ETF at any given time. Mutual funds, on the other hand, typically disclose their holdings on a quarterly basis, which may make it harder for investors to track the fund's performance and make timely decisions based on changes in its holdings. 9. Flexibility in trading. The flexibility in trading is another area where ETFs outperform mutual funds. Since ETFs trade throughout the day like stocks, investors can buy and sell them at any time during market hours, enabling them to take advantage of market fluctuations. Additionally, ETFs can be traded using advanced strategies such as short selling, options trading, and margin trading. Mutual funds, however, cannot be short sold or traded on margin, and they can only be bought or sold at the closing price of the day. 10. Automatic investing and withdrawal. Mutual funds typically allow for automatic investing through features like dollar cost averaging, where investors can set up regular, automated contributions to the fund. This makes mutual funds more convenient for investors who want to invest a fixed amount on a regular basis without having to place individual buy orders. ETFs, however, do not typically offer the same kind of automated investing features. While some brokers offer the option to set up automatic purchases of ETFs, these options are not as common or as easy to use as those available for mutual funds. Both mutual funds and ETFs are excellent investment options, but they cater to different types of investors and financial goals. Mutual funds may be better for those who prefer hands-off investing, are looking for a diversified portfolio, and are willing to accept higher fees for the potential of active management. ETFs, on the other hand, offer lower costs, more flexibility, greater transparency, and the ability to trade throughout the day, making them a good choice for cost-conscious, active investors. Ultimately, the decision between mutual funds and ETFs will depend on your investment style, goals, and the level of involvement you want to have in managing your portfolio.